Tyler, we're watching the market value stocks in the face of a little bit of interest rate instability as these rates go higher. I talked to Dr. Jeff Lacker this week from the former Fed chairman, president of the Richmond Federal Reserve Bank. He said he was surprised that we didn't see higher rates given all the stimulus we've seen over the past 12 months. I asked him what a more normal level would be, and he said, you know, easy 2 to 3% on 10 years would be more normal. I'm not sure where this normal is, but as the market is trying to find it, you're watching stocks react in a little more volatile way. I think you'll see that the 10-year will build a bottom and stocks will calm down, but it certainly builds for a bit of case of indigestion for investors coming into a weekend.
Ron, has the 5 to 10% correction you were talking about last week become more or less likely this week, or is it roughly the same?
I think we're in the middle of it, Tyler, actually. And I do think that, you know, with respect to rates, it is the rate of change that the market has the most difficult time dealing with. Yes, they're up and still historically low, but they've moved up, as Rick Santelli pointed out, so quickly that we're seeing pockets of leverage getting flushed out of the market. We're seeing valuation compressions because, you know, if you've bet that the 10-year is going to stay at 1% for the foreseeable future and all of a sudden it's at 1.5%, that just it changes the math to an extent. And you're hearing some talk about some disruptions in the 5-year note yesterday. There might be some structured products out there that are tied to government bonds that had something of a hiccup in the last, 48 hours that may have accelerated the up move in rates and as a consequence then hit the stock market. But yeah, I think this is probably the correction we've been looking for, and it's going to be dependent on the 10-year note yield.
Michael, let me turn to you and pick up on something Mr. Santelli just talked about, and that was the amount of debt that is balled up in our system, federal debt, state debt, all kinds of stuff. And you had an amazing, not just debt, but also the sort of stimulus that is in the economy these days. Do we need to start worrying about the amount of debt as it grows to something like 150% of GDP?
The answer is yes, absolutely. We need to worry about it. But I tend to listen to these really smart economists who tell me not yet. We don't have to worry about it quite yet because interest rates are still so low that debt service, costs of debt service are not really hurting us all that much. Now, the CBO, Congressional Budget Office's nonpartisan, says without another stimulus, we're going to be at $29.6 trillion in debt at the end of 2022. Now, by my math, that's just next year, Tyler. You can check me on that. But, I mean, $30 trillion in debt, and we're going to have another stimulus package, right? And we've got a $20 trillion GDP. So we're at 150% debt to GDP, first time since World War II. Right now, it doesn't seem to matter. At some point, it's got to matter, Taylor. I've got too much gray hair to think that these things won't matter forever.
Shepard Smith here. Thanks for watching CNBC on YouTube.